We have reviewed our price forecast for the Australian housing market in light of the strength over the last 6 months and with a view to assessing the impact of recent COVID disruptions. The upshot is we now see a stronger gain for calendar 2021. Prices nationally expected to be up 18% for the calendar year. We've had a very strong first half of the year. And even though COVID disruptions will clearly impact, particularly the Sydney market, those impacts are likely to be fairly mild. Prices don't tend to respond to transitory disruptions, and we have pretty strong momentum. We go back to last year, Victoria's second wave lockdown had only a marginal impact on their price performance. At that stage, we were only just moving into this upswing. So other markets were starting to see price gains. And Melbourne also moved into a recovery in terms of prices. It was a little bit more restrained initially, in part because of that second wave lockdown effect, but it didn't preclude price gains. The UK, for example, has been through multiple heavy lockdowns, some that lasted many, many months. And that didn't preclude an upturn in prices. We saw a pretty steady acceleration in UK house prices throughout the COVID disruption. So I think when it comes to house prices, it's more about the availability of credit, the balance of supply and demand, but also those medium-term expectations. But we're now looking at about a cumulative gain of 23%. We said previously back in April that a cumulative rise of about 20% is where some markets will start to really hit quite intense affordability constraints, particularly Sydney, Melbourne, also Hobart. I think the housing market's going to become a little bit detached from the wider economy. We're already seeing that. We've had this extraordinary surge in prices. Over the first half of this year, we saw an annualized price growth rate of over 25% nationally. That's a big lift in prices in any money. Compare that to the wider economy, which is still only recovering from the COVID shock in the year prior, and there's clearly already a bit of a disconnect happening between housing markets, which is very, very strong, and the wider economy, which is still moving along in fits and starts at the moment. And that's likely to continue to be the case, in part because the policy settings for the wider economy, i.e. interest rates, the RBA has made a pretty firm commitment there to only moving rates once they've achieved their targets of employment around full employment and inflation actually being on target rather than forecast to be on target. If we do a quick flyover, the Sydney market still looks to be tracking towards a 2% gain for the July month, so really not much impact from the lockdowns to date. And elsewhere, some moderation. I think Perth is probably the one that's showing the clearest moderation in price gains to monthly gains that are well below 1%. There looks to be quite a supply response happening. There's been a lift in new listings that has caught up to demand. If we look elsewhere, though, the story of a shortage of supply is still very much in place. We have sales running well ahead of new listings across all markets, at least for now, but the market should look through some of these shocks around COVID and maintain pretty good momentum that picks up again on the other side. Further out, we still expect a fairly similar profile for price growth. So our earlier forecast set down in April expected a slowdown, progressive slowdown as we moved into 2022. Firstly, as affordability constraints started to re-emerge, and then as the regulator moved on macroprudential tightening. We still see that as in the mix. The timing around macroprudential moves is a bit more uncertain now that we have this virus disruption in play and some loss of momentum likely in the third quarter. But we do expect the market to pick up pretty smartly once we get to the other side of these disruptions. And we think the regulator will need to intervene to restrain the market in 2022. We see the combined effect generating a soft landing with price growth moderating to around 5% for the full year, probably about flat in the second half of next year. And then into 2023, we will see some modest price declines. We do expect the RBA to start to move on normalising interest rates in 2023. So slightly more positive view despite those COVID disruptions near term. We do expect a better price outcome this year, but still heading into a trickier couple of years as macroprudential tightening and then interest rate rises start to weigh on the market. So further price rises, but we're probably nearing the end of the line as far as this cycle goes.